When the United States and Israel launched Operation Epic Fury on February 28th, analysts, commentators, and governments across the Western world made a confident prediction. China, they said, would be among the biggest losers of this war. The logic seemed airtight. China is Iran's largest trading partner. China buys the vast majority of Iran's oil exports. The Strait of Hormuz, now closed, is the main corridor for that energy. China's factories depend on cheap energy. Therefore, higher oil prices, disrupted supply chains, economic pain for Beijing. 7 weeks later, China's producer price index just broke a 41-month streak of consecutive declines. The Chinese yuan has strengthened against the dollar. Chinese bonds have outperformed United States Treasury bonds. And China's state refiners have been quietly drawing down a strategic petroleum reserve of approximately 1.3 billion barrels, built patiently and deliberately before a single bomb was dropped. The prediction was wrong. Not a little wrong, structurally wrong. And understanding why it was wrong tells you more about how China thinks about power than any analysis of Chinese military spending or diplomatic rhetoric. I want to walk you through this today using game theory, structural history, and the actual economic data. Because the story of China and the Iran war is not the story most people are telling. And the story most people are telling misses the most important thing happening in the global economic order right now. The global order is shifting faster than the news cycle can report. Hit subscribe to stay ahead of the curve, because what I am about to show you changes everything. Let me start with the assumption that drove the prediction, because understanding why the assumption was wrong is the key to the whole analysis. The assumption was that China's dependence on Iranian oil made China vulnerable to this war. The assumption was that Strait of Hormuz closure equals Chinese energy shock, equals Chinese economic pain, equals China loses. Every link in that chain sounds reasonable, but every link contains an error. The first error is about the scale of Iran's role in China's energy supply. Yes, China is Iran's biggest buyer. Yes, China buys somewhere between 80 and 95% of Iran's exported oil. But here's the number the analysis missed. Iran's oil accounts for roughly 10% of China's total oil imports. 10%. China imports approximately 10.4 million barrels per day. Iran supplies about 1.4 million of those barrels. That is a meaningful number, but it is not a catastrophic dependency. It is one supplier in a deeply diversified procurement system that includes Russia, Saudi Arabia, Iraq, the UAE, Brazil, and dozens of others. The Western analysis confused Iran's dependence on China with China's dependence on Iran. They are not the same thing. Iran needs China to survive. China needs Iran to optimize. Those are structurally different relationships, and they produce structurally different vulnerabilities. Keep that distinction in the back of your mind, because we are coming back to it. The second error is about preparation. China did not walk into this war unprepared. Xi Jinping said in 2021, while visiting an oil field, that China would take its energy supply matters into its own hands. That statement was not rhetoric. It was a policy directive that produced a specific, measurable outcome. In the months before the war, Chinese oil imports surged 16% as Beijing systematically built reserves. The teapot refineries, the smaller independent Chinese processing facilities that had been purchasing sanctioned Iranian, Russian, and Venezuelan crude for years through the shadow fleet, had been stockpiling at scale. By the time Operation Epic Fury began on February 28th, China held approximately 1.2 to 1.3 billion barrels in strategic and commercial reserves. That is roughly 109 days of seaborne import cover, more than 3 months of buffer, built at below market cost from the very barrels that Western sanctions were designed to strand. The US House Select Committee itself noted this in a March report. China had used sanctioned crude to build a massive strategic reserve at well below market cost. The shadow fleet, the aging tankers that switch flags, go dark on tracking, and perform ship-to-ship transfers to dodge sanctions, delivered approximately 1/3 of 10.3 million barrels per day of globally sanctioned crude directly into Chinese storage last year. Now I want to go deeper, because this is where most people's analysis completely breaks down. The third error is the most important one, and it is about what kind of economic problem China was actually facing entering this war. For more than 3 years, China has been fighting deflation, not inflation. Deflation, the persistent decline in prices that makes borrowing more expensive in real terms, crushes corporate profits, discourages household spending, and creates what Chinese economists call insufficient domestic demand. The producer price index, the measure of what factories charge for goods, had been negative for 41 consecutive months before this war began. That is 3.5 years of declining factory prices in a country whose economic model depends on manufacturing competitiveness and export growth. Deflation is the enemy of credit-driven growth. It is the reason Chinese households are reluctant to borrow when they believe prices will be lower next year than today. It is the reason Chinese businesses defer investment when they believe their competitors will undercut them further if they wait. And it is a problem that conventional monetary policy cannot solve easily, because China's benchmark interest rate is already at 1.4%, leaving almost no room for further cuts. Then the Iran war started and oil prices went to $100 a barrel. In March of 2026, China's producer price index turned positive for the first time in 3.5 years. It ticked up to 0.5% year-on-year. Energy-intensive industries saw the sharpest moves. Non-ferrous metal mining surged 36.4%. Non-ferrous metal smelting jumped 22.4%. These are not rounding errors. These are structural price shifts in industries that had been crushed by deflationary pressure for years. A senior economist at China Banking News made an argument that deserves to be taken seriously. A short, sharp oil price shock, managed carefully with fiscal and monetary policy, could provide what years of conventional stimulus failed to deliver: a break from deflationary expectations. Once households and businesses stop expecting prices to fall, credit demand recovers, investment recovers, growth recovers. The war that was supposed to hurt China is doing something that 3 years of Chinese economic policy could not accomplish. It is ending deflation. Think about what that means for the ordinary Chinese family. Prices have been falling for 3 years. Everything from electronics to food to manufactured goods has been getting cheaper, which sounds good until you realize that falling prices mean falling corporate revenues, falling wages, rising unemployment in manufacturing, and a general reluctance to invest or borrow. The end of deflation, achieved in this paradoxical way, means the beginning of a recovery cycle that Chinese policymakers have been trying to engineer since the end of the pandemic. Now, most analysts at this point would say, but oil prices hurt Chinese manufacturers too. Higher energy costs mean higher production costs. Higher production costs mean less competitive exports. This is the standard analysis, and it is not wrong. But here is the reality. It is incomplete in a way that matters enormously. China's economy has been transforming its relationship with oil for 4 decades. In the 1980s, China's oil intensity, the amount of oil required to produce a unit of economic output, was extremely high. Since then, that oil intensity has fallen by approximately 80%. China has electrified its economy at a pace that no other major industrial nation has matched. By 2024, electricity accounted for 24% of China's total energy consumption, a dramatic shift from fossil fuel dependence. China's electric vehicle penetration is the highest in the world. Its solar and wind generation capacity is the largest in the world. Its high-speed rail network running on electricity has replaced enormous volumes of diesel-powered road freight. The practical consequence of this transformation is that the relationship between global oil prices and Chinese economic competitiveness is fundamentally different today than it was in 2005 or even 2015. A 30% rise in oil prices that would have significantly damaged Chinese manufacturing 2 decades ago produces a much smaller relative impact today. And because the same oil price rise is devastating Western manufacturers whose oil intensity reduction has been slower and less systematic, the relative competitive damage to China is smaller still. China has been building an economy that is less exposed to the specific weapon that was deployed against Iran, and by extension, against the global economy. It spent decades doing it, and the war has revealed the extent to which that preparation has succeeded. The fourth force is the financial dimension, and this one surprises people who think about China primarily in terms of factories and energy. When global risk events occur, capital typically flows toward the United States. Investors buy US Treasury bonds, which drives bond prices up and yields down. The dollar strengthens. This is the standard risk-off pattern that has defined global finance for decades. The Strait of Hormuz closure was supposed to trigger this pattern. Fear, uncertainty, flight to safety, dollar up, everything else down. Instead, the Chinese yuan strengthened against the dollar. Chinese government bonds outperformed US Treasury bonds. The dollar weakened on a trade-weighted basis as markets priced in the cost of an energy crisis centered on a war that America started and has not been able to end on its terms. This shift matters beyond the numbers. One of the constraints on China's use of the yuan in international trade has always been the perception of the dollar as the irreplaceable safe haven. Every time a crisis produces dollar weakness instead of dollar strength, that constraint loosens slightly. The war has created a moment, not the decisive moment, but a meaningful moment in which the global financial system is asking whether the dollar's safe haven status is as permanent as assumed. The fifth force is the one that is hardest to quantify, but may be the most consequential in the long run. The Iran war has eroded American soft power in ways that directly benefit China. International polling conducted during the war shows consistent patterns. Favorable views of the United States have fallen across the global south, across Southeast Asia, across the Middle East, and even in parts of Europe. The imagery of American bombers over Iranian cities, the killing of a supreme leader, the threats to destroy civilizations, the attack on Pope Leo, the blockade that Britain and Spain refused to join, these have produced a reputational cost that cannot be measured in barrels per day, but that shapes the alignment decisions of governments for years. China has been the visible alternative. Chinese diplomats called for peace. The White House acknowledged that high-level US-China talks preceded the ceasefire. Pakistan, China's closest strategic partner, hosted the negotiations. China's foreign minister made phone calls to every relevant capital. China presented itself as the responsible stakeholder that the United States demonstrably was not. In structural history, reputational shifts of this kind are slow to accumulate and fast to consolidate once they reach a threshold. The British Empire did not lose its global authority in a single moment. It lost it through a series of events, each of which slightly eroded the perception that Britain was the reliable center of the global order. The Suez Crisis of 1956 is usually identified as the decisive moment. But Suez was decisive only because of everything that had accumulated before it. The pattern in structural history is consistent. The dominant power's credibility erodes at the margins, through a series of episodes that each individually seem manageable, until one episode crystallizes the erosion into a visible, durable shift. China's strategy in this war has been precisely calibrated to contribute to that erosion without triggering the kind of direct confrontation that would allow America to reframe the conflict as US versus China rather than US versus Iran. China armed Iran through deniable channels. China pushed Iran toward the ceasefire. China positioned Pakistan as the negotiating venue. China's foreign minister made 26 phone calls. None of this required China to fire a single missile or commit a single soldier. All of it accumulated toward a global perception that China is a responsible stakeholder and America is a destabilizing force. That perception, once established in the minds of governments making strategic alignment decisions over the next decade, does not reset when the war ends. The war is not the turning point. It is evidence that is being incorporated into decisions that will produce turning points later. The Iran war is not China's Suez moment, but it is accumulating the kind of reputational evidence that makes a future inflection point more, not less likely. Now let me tell you what to watch in the coming months, because the picture I have described here is still developing. The first thing to watch is whether Chinese deflation ends durably or temporarily. The March producer price data showed the first positive reading in 3.5 years. If that turns into a sustained trend through the second and third quarters of 2026, Chinese policymakers will have achieved through an external shock what they could not achieve through domestic stimulus. That would have profound implications for Chinese economic confidence and consumer behavior. If it reverts back to deflation after the oil price spike subsides, the window of benefit will have been real but limited. The key indicator to track is the month-on-month trajectory of China's producer price index through June. 3 consecutive positive readings would represent a genuine trend break. Anything less is a temporary respite. The second thing to watch is Chinese reserve drawdown velocity. China holds approximately 1.3 billion barrels in strategic and commercial reserves. The government has authorized state refiners to tap commercial reserves. How quickly those reserves are drawn down tells you how long China's buffer lasts, and at what point Chinese demand for alternative suppliers becomes acute. If the war extends significantly beyond the ceasefire window, the buffer shrinks and the vulnerability increases. The math is manageable for weeks. It becomes more serious over months. If Iranian exports are structurally constrained for more than 60 days, watch for signs of Chinese demand shifting towards Saudi Arabian and UAE crude at market prices, which would partially close the discount advantage China has been running. The third thing to watch is yuan internationalization. Every episode of dollar weakness in a crisis context creates a small window for yuan expansion and trade settlement. Watch whether any Gulf state, any commodity producer, any significant importer announces even a partial shift toward yuan-denominated transactions in the aftermath of this conflict. Saudi Arabia has been the key indicator for years. The day a meaningful fraction of Saudi oil sales are settled in yuan rather than dollars, the petrodollar architecture begins its structural transition rather than its theoretical one. The fourth thing to watch is the May-Beijing summit. Trump is traveling to China to meet Xi Jinping, the first US presidential visit to Beijing in 8 years. This visit is happening in a context where China has cushioned the war's economic impact better than almost any other major economy, where China's diplomatic positioning has been more favorably received internationally than Washington's, and where America needs Chinese cooperation to maintain the ceasefire with Iran. The power dynamic in that room will not match the formal protocol that places a sitting US president in Beijing. Watch the concessions that are announced. Watch what China extracted as the price of its cooperation on Iran. Whatever is framed as a mutual benefit, the incentives will tell you who paid the real cost. A president traveling to a rival's capital always pays more than the formal statement suggests. The structural conclusion is this. The prediction that China would be a loser in the Iran war was based on a model of Chinese vulnerability that is a decade out of date. It assumed that China is still deeply dependent on Middle Eastern oil flows, without substantial reserves, without an electrified economy, without the financial resilience that comes from a strengthening currency and outperforming bond market, and without the diplomatic positioning that comes from being the visible alternative to a United States conducting a war that most of the world opposes. The China of 2026 prepared for this, not for this specific war, for exactly this category of disruption. And the preparation, built over years through strategic stockpiling, economic electrification, reserve currency diversification, and diplomatic positioning, has held. This is not prophecy. This is structural history combined with game theory. I might be wrong about whether the benefits persist if the war extends significantly beyond the current ceasefire. I might be wrong about the speed of the deflationary break. If I am wrong, we will come back and analyze why. Save this analysis, come back in 90 days. Check whether Chinese producer prices are still positive. Check whether the yuan has held its gains. Check whether the May summit produced the concessions the incentive analysis predicts. The answers will tell you whether the structural picture I have described here reflects a temporary moment or a durable shift. Subscribe if you want to follow this analysis as it develops. Because the story of China and the Iran war is really the story of whether American strategic primacy in the global economic order is as durable as it appears. And the early evidence is not encouraging for those who assume it is.